Welcome to Cash Flow and Tell, the podcast that uncovers answers to your toughest questions about growing your business from a working capital perspective. Hosted by the people of FundThrough, we dive into real stories and lessons from CEOs, finance pros, and business owners just like you. Today, we're covering the how and why behind designing your ideal capital stack. Now, here's your host, JC Mattos, Chief Operating Officer at FundThrough.
If I offered you $1 million today and told you it would cost you $50,000 to use it for 60 days, would you take it? Most small and mid-sized businesses owners instinctively say, that sounds expensive. Now, let me ask you a better question. If that same $1 million allowed you to secure a contract that would generate $300,000 in gross profit, would you still call it expensive? This is the capital stack mistake I see over and over again in small and mid-sized businesses. When I say small and mid-sized businesses in this episode, I'm talking about companies doing roughly $5 to $50 million in annual revenue. Owner-led, operator-driven, often profitable, often growing, frequently selling to large buyers with longer payment terms. At some point, someone tells them factoring is expensive, usually followed by it is 2 to 3% per month, 24, 36% APR, just get a bank line. Today, I want to dismantle that comparison properly, not emotionally, not defensively, structurally. Because the real mistake is not misunderstanding factoring. The real mistake is failing to intentionally design a capital stack. If you confuse short-term liquidity tools with long-term debt, revolving credit cards, merchant cash advances, or equity, you'll make bad financing decisions. And bad financial decisions quietly kill otherwise good businesses. Let us start with first principles. If you sell to large buyers on net 30, 60, or 90-day terms, your cash conversion cycle looks like this. You incur costs today, you deliver today, you invoice today, you get paid 60 days later. In the meantime, you pay payroll, you pay suppliers, you pay rent, you pay tax. That 30 to 90-day gap must be financed. There are only 5 ways to finance it: internal cash, a bank line of credit cards, merchant cash advances, invoice-based financing. Each one has a different structure. Structure matters more than the headline rate. Let us start with the bank line of credit. On paper, a secured bank line at 7% to 10% APR is cheaper than a 2.5% at a 30-day invoice fee. That is true in isolation. But when small and mid-sized businesses often ignore 4 things. First, qualification. Banks underwrite heavily on profitability history, tangible net worth, debt service cover ratios, financial covenants, and personal guarantees. Many businesses in the $5 to $50 million range either do not qualify for limited capacity, or has a very restricted covenants in place. Second, elasticity. A bank line has a ceiling. Invoice-based financing scales with receivables. If revenue grows 30%, availability grows with it. Your bank line does not automatically increase. Third, covenant risk. Bank lines often include minimum EBITDA requirements and leverage tests. Miss one covenant during a soft quarter, and your line can be frozen or reduced. Invoice-based finance is tied to invoice quality, not quarterly EBITDA. Fourth, speed. Bank underwriting can take weeks or months. Invoice-based financing decisions are typically transaction-focused and faster. Is a bank line of credit cheaper capital for stable businesses? Yes. Is it universally available, elastic, and covenant-free? No. Now, let me get you a real-world example. A $22 million industrial services company landed a new $6 million annual contract with a large energy buyer on net 60 terms. To execute the contract, they needed roughly $1 billion in additional working capital. The bank said yes, but it would take 6 to 8 weeks, and it came with a tighter covenant. An MCA provider offered 1 million immediately, but repayment would total roughly 1.3 million with daily deductions. Instead, they used invoice-based financing tied directly to the new receivables at roughly 2.5% for 30 days. On $1 million for 60 days, the cost was around $50,000. That $6 million contract generated about 1.8 in annual gross profit. They paid roughly $50,000 to unlock over 1 million in gross profit. That's not expensive. That's leverage. Now, let's zoom out a little bit. And instead of arguing about whether one tool is expensive, serious operators ask a different question. How should I design my capital stack? Capital stack design means intentionally layering different financing tools based on cost, flexibility, risk, duration, scalability, covenant, and speed. You do not have to choose one tool. Actually, you should not be choosing one tool. You design a system. Here's what you should consider when building one. First, stability of revenue. If revenue is stable and predictable, you can safely use lower cost, covenant-based debt. If revenue is volatile or project-based, you need more elastic tools tied to invoices. Second, gross margin profile. Higher gross margins can support short-term duration transaction-based financing. Lower margins require tighter cost control and lower cost capital. Third, growth rate. You're growing 20% to 40% annually. Elasticity matters more than lowest possible rate. And fourth, risk tolerance. Do you want covenant risk tied to EBITDA or financing tied to actual receivables? Fifth, liquidity buffer. How much dry powder do you need to sleep well at night? Now, how many options should you have? Most small businesses should not rely on one single financing source. One tool creates fragility. 3 to 5 tools create resilience. A well-designed stack for a 15 million to 30 million business might look like this. Layer 1, internal cash reserves equal to 1 to 2 months of operating expenses. Layer 2, a mold-as bank line of credit for baseline liquidity at lower cost. Layer 3, invoice-based financing to handle growth spikes and long payment terms. Layer 4, a small credit card facility for short-term float and operational convenience. And layer 5, equity as a strategic capital only, not emergency liquidity. Notice what's missing. Merchant cash advances should not be a core layer. They are emergency tools, not strategic layers. The key is intentional allocation. For example, you might decide, based on operating needs, are funded by internal cash and bank loan. Growth-driven receivables are funded by invoice-based financing. Tactical short-term gaps are covered by credit cards, but paid off monthly. That is design. Now, let's just revisit the comparison credit cards and MCAs, merchant cash advances, briefly. Credit cards compound and linger. MCAs impose rigid daily deductions at effective annualized costs, often between 40 to 80%. Invoice-based financing is short-term duration, self-liquidating, and scales with revenue. APR is useful for long-duration loans. It is less useful for short-duration, self-clearing transactions. A $500,000 invoice at 2.5% for 30 days costs about $12,500. If unlocking that capital generates $40,000, $50,000 in incremental gross profit, the return is obvious. Sophisticated operators do not ask what is the annualized rate. They ask what is the return on accelerated capital. This tool is not appropriate for every business, though. It does not fix negative margins. It does not rescue structurally weak companies. Capital amplifies a strategy. It does not replace it. Small and mid-sized businesses between 4 and 50 million in revenue often hit a capital inflection point. Growth outpaces cash. Customers pay slowly. Banks move cautiously. The wrong reaction is to anchor on headline percentages. The right reaction is to design your capital stack intentionally. Capital is not about ego. It is about velocity, flexibility, risk alignment, and resilience. If you evaluate financing tools only by headline rate and do not think about the structure, duration, scalability, and covenant risk, you're underanalyzing your own business. And serious operators do not underanalyze capital. They design it. Let's go over the key takeaways that are most important for you to remember. 1. Do not confuse short-term liquidity tools with long-term debt. They have different structures, different durations, and different purposes. Comparing them by APR alone is like comparing a rental car to a mortgage. Structure matters more than the headline rate. 2. A single financing source creates fragility. 3 to 5 intentionally layered tools create resilience. Internal cash, a bank line, invoice-based financing, credit cards, and equity each serve a different role in your capital stack. Design the system. Do not default into one tool. 3. Invoice-based financing is short duration, self-liquidating, and it scales with revenue. It does not require covenant compliance or months of underwriting. For fast-growing companies with long payment terms, it fills a gap that banks' lines often cannot. 4. Stop asking what the annualized rate is. Start asking about the return on accelerated capital. If $50,000 in financing cost unlocks $300,000 in gross profit, that is not expensive, that's leverage. 5. Capital amplifies a strategy. It does not replace it. If your margins are broken or your business is structurally weak, no financing tools fixes that. But if your business is sound and growth is outpacing cash, the real risk is not the cost of capital. The real risk is leaving money on the table because you underanalyze your own capital stack.
Thanks for listening to Cash Flow and Tell. From all of us at FundThrough, we hope this episode got you one step closer to growing the business of your dreams. Make sure to hit that subscribe button. We'll see you next time.